Welcome to Breaking News to Trading Moves.
Today we're looking at a major corporate event, a strategic repositioning, and what it means right now for the media, connectivity, and advertising markets.
Yeah, our goal is to really analyze the market's reaction and pull out the immediate winners and losers so you can get a quick handle on where the focus has landed.
That's it. We're going to assess the implications of this one company's decision on the wider market.
Giving you a rapid assessment of which companies and sectors might gain ground.
And which ones are facing some immediate pressure, all based on this one structural announcement.
Okay, let's start with the event itself. So the headline confirms that Comcast approved the separation of its cable network portfolio.
Right. Into a new, independent public company.
And this new entity is going to operate under the name Versant Media Group.
And this is a classic, though a very large-scale example of what the financial world calls a sum-of-the-parts strategic move. The key rationale here is pretty clear. Comcast, the parent company, wants to surgically isolate and spin out those, slower growth linear cable network assets.
So they're essentially carving out the part of the business that investors have been seeing as a drag on their valuation.
Precisely. Comcast Corporation, which will stay under the ticker CMCSA, is keeping its core connectivity services.
Broadband, wireless, that kind of thing.
Exactly, along with its other high-growth engines. By separating out Versant Media Group, they're presenting a much cleaner growth story to the market.
The hope being that the market will assign a higher value to the two separate companies than it did to the one big conglomerate.
That's the hope. Higher cumulative value.
So why does this action matter so much? It's not just an internal accounting adjustment, is it?
No. It's a formal acknowledgement of the changing economics in media. This separation just accelerates that broader trend of media companies dismantling their legacy structures.
And it forces the market's hand.
It does. It forces the market to value the cash flows from linear cable with total transparency. And that creates a brand new benchmark for every other media company that still has these kinds of assets.
So let's get into the beneficiaries. If the theme here is simplification and transparency, who are the immediate winners from this?
We can start with those who gain from what we're calling breakup and spin-off optionality.
Okay.
This is all about value unlocking. Whenever a large media company successfully segments its assets, it often benefits the stock of the parent company that's left behind.
Right. Investors like simplification.
They love it. They often re-rate the remaining business higher because the story is cleaner and the growth prospects seem clearer.
And you said this sets a precedent. So who are the peers that are now, immediately under the microscope?
Well, the market scrutiny instantly goes up for other companies with similarly complex structures.
Okay.
We're talking about Warner Bros., Discovery, that's ticker WBD.
Ticker BBD, got it.
And Paramount Global, ticker PARA.
Okay, so both of them have spent the last few years combining or acquiring all these different asset groups, streaming platforms, film studios, and those same legacy cable networks.
Exactly. So because Comcast has now effectively said, we're selling off our slow growth parts, investors look at WBD and PARA and they start asking,
when are you going to do the same thing?
That's it. Comcast has provided the playbook and a potential valuation for this bad bank of assets, so to speak.
And that puts pressure on management.
Immense pressure.
Yeah.
Investors in WBD and PRA will want them to pursue similar separations to create cleaner financial narratives. This optionality gets priced in, and investors who want focus see it as a positive.
That makes a lot of sense. Now let's look at some secondary winners. This is where it gets a bit more technical, but it's really critical.
The infrastructure players.
Right. The exchanges and market infrastructure, they benefit just from the activity of the spinoff itself.
Absolutely. I mean, think about the pure mechanics of creating a new public company.
It's a lot of work.
And it generates a lot of corporate action trading volume for the exchanges.
Can you tell us a bit more about those mechanics? What specific actions create that volume boost?
Sure. So a new listing, especially a big spinoff like this one, creates these bursts of activity. First, you get something called when-issued trading.
That's where people trade the security before the shares are even officially out there.
Right. And second, you have this huge requirement for index rebalancing. Large indices like the S&P 500 or the Russell indices have to adjust their holdings.
And that forces all the big institutional funds that track those indices to buy and sell.
Huge quantities all at once. It's a massive driver of volume and data consumption.
So the direct beneficiaries here are the market operators, the data venues that facilitate all these trades.
That's right. So we look specifically at NASDAQ Inc., ticker NDAQ, and Intercontinental Exchange, ticker ICE. They process that volume and data, and it translates directly into transaction fees and higher data licensing revenue for them.
Okay, let's pivot back to content for a moment before we get to the downside. If Comcast is isolating the weak parts, the structural advantage has to go to the established streaming-first leaders.
They absolutely gain a relative advantage here. As these legacy linear assets are separated and their value gets formally established or, marked to market, it just reinforces the most important structural point in media today.
Which is the decline of the traditional cable bundle.
The decline of the cable bundle. The narrative for streaming has been building for years, but an event like this really validates that argument.
It puts a spotlight on it.
It does. It highlights the accelerating decay of the old model, and that reinforces the market view that streaming native platforms are grabbing more viewer attention and, consequently, a larger share of ad budgets.
The market sees a clear advantage for the pure-play streaming companies that don't have all this legacy baggage.
No baggage. So the names that benefit here.
Let me guess. Netflix.
Netflix Inc., ticker NFLX, is the gold standard for subscriber scale. And Roku Inc., ROKU, which is positioned as a leading distribution platform for streaming ads. They are not encumbered by the issues now bundled up in Versant Media Group.
Okay, so if those are the beneficiaries, where is this corporate action causing some downside pressure? Let's turn to the companies now facing some headwinds.
The first area of pressure is focused right on peers with linear cable network exposure.
And the risk they face is what analysts call multiple compression.
Right. Let's quickly define that.
Please do.
So when a company spins off its least desirable assets, and those assets are then valued cheaply by the market, that new low valuation becomes the benchmark for all comparable assets across the industry.
So if Versant Media Group trades at a really low earnings multiple,
Then every dollar of earnings from linear cable and other companies is now expected to be valued that cheaply too. It compresses the overall valuation of the peer companies.
which means creating a pure-play cable entity makes it much harder for these linear declines to be hidden or offset by the stronger parts of a diversified parent company.
Exactly. So the peer facing this direct pressure is Fox Corporation, ticker FOX.
Okay.
Fox still holds substantial cable network assets in its portfolio. The market will immediately compare the value assigned to Versant's assets against Fox's own linear holdings.
And if Versant is valued low, the pressure on FOX's valuation goes up immediately.
Immediately.
Okay, next, let's look beyond the content creators to the whole distribution system, specifically the pay TV ecosystem and cable distributors. This event really heightens the public focus on cord cutting.
That's a crucial secondary effect. Any major high-profile move that calls attention to weakening cable networks, like a spin-off of this size, contributes directly to concerns about accelerating subscriber losses.
It also increases headline risk around things like programming disputes and just general customer churn.
And the distributors are sort of the high-wire middleman in this whole environment.
Caught between two powerful forces.
They really are. On one side, they face rising programming costs from the content creators. On the other, they're battling changing consumer habits and declining subscriber numbers. It's just a structurally challenging business model right now.
So who are the specific distributors that are named in this category?
Well, the operational challenges of Charter Communications, ticker CHTR,
CHTR.
and Dish Network, ticker DISH, are immediately spotlighted by this move. The market expects more pain for the traditional pay TV platforms when content suppliers are this explicitly decoupling from the old model.
Got it. Okay, our final category for market pressure involves traditional ad agencies. We're looking at the agencies still heavily focused on buying slots on legacy linear TV.
Right. I mean, if advertising dollars continue their multi-year migration away from linear cable and toward these highly targeted streaming and performance-based channels, it creates a serious issue for the traditional buyers.
And how does that impact the agencies directly? It sounds like they're just fighting for a smaller and smaller piece of the pie.
They are. As the available viewership on linear cable shrinks and digital platforms offer better measurability, agencies that specialize in legacy TV planning just experience reduced pricing power.
They see slower growth.
Slower growth, and critically, client budgets get reallocated, favoring their digitally native competitors. It's a direct migration of capital away from their core expertise.
And the specific traditional ad agencies the market is watching here are...
The names that get mentioned are Omnicom Group, ticker OMC, and Interpublic Group, ticker IPG. Their performance is very tightly linked to the health of that traditional media advertising ecosystem.
which this Comcast move is basically formalizing as a declining asset class.
That's a good way to put it.
So this event is clearly more than just a press release. It's dictating the market's focus for the next several quarters. Let's wrap up with 3 specific areas for you to watch in the market stemming from this.
Okay, point number 1. That involves the immediate event-driven flows. You need to meticulously watch the price action around Comcast CMCSA itself. The market will be doing a live calculation to determine the value split between the remaining parent company and the new Versant Media spinoff. That trading activity will dictate the immediate success of the whole thing.
Point 2 focuses on the peer sympathy moves. So we should be looking for volatility in the valuation comparisons of this new Comcast structure against its peers Warner Bros., Discovery, WBD, and Paramount Global, PARA.
Yes, but pay special attention to Fox Corporation, FOX. How the market prices Fox's mixed portfolio relative to the pure-play Versant Cable Group will tell us everything about the sentiment on linear media.
And the third and final point.
And finally, point 3, you track market sentiment changes in the distribution and advertising ecosystem. Specifically, watch Charter Communications, CHTR, and those ad agency names, OMC and IPG.
Right.
The market will be watching to see if the valuation pressure extends to them. That would signal that the negative implications of the spin-off are being widely accepted as a new norm for the industry.
That's a very comprehensive framework. Let me offer a concluding perspective to consider. A business separation is a strategy, but it's not an operational solution. How much long-term value creation can really be achieved just by dividing a business on paper versus making genuine changes to the underlying operations and future strategy of what's left? That is the real test for Comcast and its peers moving forward.
A great thought for you to hold on to.
Thank you for joining us for this analysis.
This is not financial advice or buy or sell recommendations. This is purely the opinion of the author.